The failure of Silicon Valley Bank has many people taking a second look at the security of their savings. This afternoon, our financial expert Paul Hood is with us to discuss how to protect your finances. Paul, thanks for being here. It's been in the news a lot. You know, and I remember my great-grandparents were worried back in the 20s. They didn't like banks. You know, they kept all their money at their house. But, I mean, should people be worried about this? First off, let's start with FDIC insurance. What is it? How does it work?
Yeah, so to encourage confidence in banks, the government came up with this federal deposit insurance company that guarantees up to $250,000 of your deposits in a federally insured bank. So you want to make sure that there's that big FDIC sign on the bank you participate with. The credit unions have their own thing, but it's similar.
Cool. With this bank, they only protect up to $250,000. Is there a way to have more than $250,000 in coverage?
Yeah, so one thing, you know, because I've gotten a couple calls from clients, and you can go to FDIC.gov, and they have an estimator that you can type in literally what accounts you have at what banks, and it'll tell you what you're insured. So it's generally speaking, it's limited per institution. So the easiest way is to spread your money around. But some, like trusts that have multiple beneficiaries, if it's a revocable trust, can be treated as 3 different accounts. Sometimes a joint account can double up on that. So go to FDIC.gov and do that estimator.
Gotcha. What's not covered by FDIC?
So by definition, deposits, cash equivalent is what's covered. So CDs, savings account, checking account, prepaid gift cards, those are covered. A retirement plan is covered, but only to the extent that those assets are held in deposit accounts. So if you've got an IRA at a bank and you've got so much in cash and so much in equities, the equities is not covered.
And then how can somebody check to see if all of their accounts are fully covered?
Well, again, what I would recommend people do is first, there's 2 things. One, you can go to the bank and ask, how much protection do I have? 2, go to FDIC.gov and you can do that estimator. Separate each different banks, and then they have different categories that go in there and different ownership that you can see. Now, the one thing is I'd like to say, and I don't have a crystal ball, but emotion drives things, whether you're talking Bitcoin or you're talking run on banks. You know, our banking system is strong, and especially here in our part of the country, you know, they're pretty conservative, so I wouldn't get overly concerned. Now, if you're investing in a bank or a national bank that's got a lot in Bitcoin or doing speculative type investments, maybe you should be concerned, but don't run down to the bank and pull all your cash out.
Well, and I think some people worry too, because, you know, they think about the Great Depression or something, but banking was so much different in the 1920s, and they've changed it a lot even since 2008 and stuff too, is that right? Yeah,
there's no, you know, back then there was no fail-safe. You know, it was just, you know, well, you're on your own. Well, now they understand, you know, our government, and I'm not a big government regulation guy, but in this case, it's important to understand. And just because a bank fails doesn't mean you're losing all your money. You know, it's insured up to that $250,000. There for a bit, they raised it to $300,000. Now it's back to $250,000. And but the bank, if they go down, FDIC is going to come in and take over and liquidate assets, and maybe you'll get some more of your money. But be smart, but don't be fearful.
All right, Paul, great advice. Thanks so much. We appreciate it.